Brad Thomas here at the Street. I'm joined today with Ben Butcher, CEO of STAG Industrial. Ben, good to see you today.
Nice to be here. I will confess that on a rainy Friday afternoon in Boston, I have let my tie down a little bit, but I'm happy.
Sounds good. Well, Ben, congratulations. STAG had an amazing quarter, second quarter. NOI up 59% and FFO, funds from operations, up 83%. What's driving that, and how do you see this for the rest of the quarter, rest of the year?
Well, it's Brad. In our recent call to go over our earnings, I found myself using the word "continue" in almost every sentence. We have an investment thesis that we think will continue. There it is again, to produce unusually good returns because we're a relative value buyer. We're buying assets for less than we think they're worth based on their ability to produce cash flow going forward. We're also a great, obviously, in the current rate environment, a great spread investment player as well. So we expect to continue to produce very large returns, and we have relatively little competition on the type of assets we buy, which allows us to buy in pretty sizable volume, relative to the size of the company. We've given guidance year over year that we expect to buy 25% additional assets, growth in square footage of our assets. Last year we grew about 70%, and we're about through the end of June we've grown about 20% this year. So we feel that 25% number is pretty achievable for the remainder of the year.
Great. Well, Ben, STAG is an industrial REIT, hence the name STAG Industrial. What does STAG stand for? I know you've got 194 big box industrial buildings, but what does that stand for, and how does that compare to the triple net sector?
Well, STAG stands for Single Tenant Acquisition Group. The original thesis is based on sort of what we think is persistent mispricing of some of these large industrial assets. We are the nuanced answer to what we are is we're an industrial operating company, but we're really pursuing a net lease strategy. We buy shorter term net leases. We buy perhaps secondary markets more than other people. But in doing that, we are still focused on net leases because of the feature that we do not have to manage the buildings. The principal property manager is the tenant themselves. That's very similar to the net lease companies. So we kind of have a foot in both camps. We think of ourselves, though, first and foremost as real estate people, industrial operating people. And I think the measure of that is that when we have a vacancy, it's our goal to release that building, to recapture the value of that building for our investors.
Great. Well, I noticed in your recent earnings, your SG&A load, I believe, was around 17%. Seemed a little higher than the peer group. What's causing that, and how do you see that going forward?
Well, we're for better or for worse, we came to be a public company 2 years ago with a lot of the bells and whistles that we needed to operate as a public company. And I think that's why we've performed as well as we have. Is we had the people in place. We didn't need to add sort of bodies to make sure we could do it. We have continued to add bodies, though, as we scale our business. We've more than doubled our asset base since the IPO. But if you think about that 17%, that's our average SG&A load. What's interesting is that, say, if we bought $300 million of assets in this year, we would probably have to add one accountant, one asset manager, and maybe a piece of a credit person. We do our own internal credit reviews. And the cost to the company of those people is maybe $400,000 all in. Let's go crazy and double that and say it's $1 million. Well, that $300 million of assets that are circa 9 cap acquisitions is $27 million of income. So at the margin, we're around that SG&A load is around 4%. So as you can see, as we continue to grow and grow accretively, we will drive down that SG&A load, we think, pretty significantly.
Well, Ben, thanks for joining us today in rainy Boston, and we look forward to seeing you next time.
Thanks so much, Brad. Always good to talk to you.
You're welcome.